Samit Vartak joins us, CIO and partner with the SageOne Investment Advisors. And he, in a sense, is not a large cap investor, but a mid cap maverick, believes in buying companies which could grow between 15 to 20% because he believes that for a market like India, that is where you should really be focusing in on. So nice to have you back. Thank you for joining us. Mid and small cap stocks are in headline for the wrong reasons. Everyone is feeling the pain of excesses which got created last year. What is your sense? Do you think we are nearing the end of the decline, or there is still some more froth in the system?
Hi, Nikunj. A pleasure to be here. See, I think mid cap, small cap is a pretty vast universe. So anything below 1 lakh crore is mid cap, and anything below 30,000 crore is small caps. There are about probably 4,500 companies in the small cap basket. Right. And I think, unfortunately, what happened was in the last few years, across the board, the smaller the stock, the higher has been the rise. And many investors have been investing, without really digging deep into the companies, for the promoters and looking at the business model, because the stocks used to move so fast that, invest first and then research later kind of philosophy was pretty prevalent. And more importantly was, the pre-IPO, IPO kind of deals where, it was all about the Excel kind of future of the companies, where companies, we used to also get multiple deals, almost, 4 or 5 deals a week in the pre-IPO. And, all the projections were like, 4 or 5x in the next 3 to 4 years. And it's impossible, when thousands of companies are projecting such kind of a growth. So there is a lot of froth, in that market, in the smaller companies, where a lot of operators also got probably active, and then, a lot of the prices were active. But then again, if you're just looking for 15, 20 stocks, there are a lot of opportunities which are emerging, right? For me, it's all about what is your long-term returns goal. If you're targeting 20% plus returns goal, it's almost impossible to make that in the large caps, right? So the only way you can find 20% plus earnings growth companies is most often in the small and mid cap space, right? So here you can't take a basket approach, but it's all about specifically finding companies, betting on promoters, finding on companies who are the best in the industry, who are gaining market share. These are the core, because in a good market across the board, the entire, the tide raises all the boats, and it's very difficult to differentiate, which is the right boat to ride. And I think that's where, going forward, that's the important part. I don't think the entire universe has corrected enough. There is a lot of fraud still remaining in terms of valuations. But if you are a good stock picker, I think that's the market, going forward. If you look at last 3 or 4 years, every year, almost, the percentage of companies beating the BSE 500 or equal weighted BSE 500 index beating the normal BSE 500, the weighted average index used to be way higher, above 50%. And that's that can't continue for long. After a long time, that percentage of companies has come down to as low as now 30%, right? So 70% of the companies are not beating the index. And in this market, then your universe, which you can which will outperform, will shrink significantly. So now important that you just don't bet on the entire sector or entire theme, but bet on promoters and stocks.
So let's use the hurdle rate which you've used. Buy a company which has potential to grow at 20%, which means potentially profits can double in 3 to 3.5 years. If that is the case and a little bit of P expansion, the stock could easily more than double in 3 to 5 years. Where are you picking your spots where you think that in this kind of a market, you're reasonably confident of a 15 to 18% kind of an earnings growth?
So I think the pockets, again, where I'm finding ideas are, into the specialty chemical space. After a long time, they are getting cheaper with sort of the rupee going down. And, there is obviously it went through a big correction. So valuations is in your favor. There is a pharma space, which is really looking good. Again, in this market. There has been correction. Gold finance looks pretty good. Home finance looks decently good. Luxury real estate, is looking good. And I continue to like, the building materials. Building materials again. I think it's going to be a, really high growth time for a lot of niche building materials. Like fabrication pies, electrical cables, conductors, a lot of even transformers. So whether the building materials are in the construction space or power space, I really like the power space. But again, it's all about which company are you going to pick, right? I mean, you have so many examples in when NBFC struggled, Bajaj Finance, Chola did exceedingly well. There are only two companies which really did really well across when that space did nothing. Even in the agrochemical space, PI Industries kind of a company did so well. So it's all about, I think, stock picking, betting on the promoters, making sure you understand the core competencies of that business, whether those are sustainable in nature. You can't bet on just low valuation or high margin, because a lot of times those are very temporary in nature. In good market, it's very deceiving. What is the it's very difficult to differentiate between good and bad, and you need such tough times to differentiate between good and bad. So I understand that a lot of investors who are going through this pain for the first time, it's excruciating, it's very difficult, it's stomach churning. But these are the times when you will really solidify yourself as a good investor. These are the only times which really teach you what investment is, and you will thank these times in the future. Otherwise, good markets make you a very, very weak, shallow investor. These kind of markets is what you need to increase your depth, and that depth is what will deliver you phenomenal returns going forward. So take this as an opportunity to learn, differentiate between businesses, and you'll thank yourself later on.
Okay, so I'll be specific here just for the benefit of our viewers. Power, and that is one sector where so many opinions are there. Power, power ancillary, thermal, non-thermal, renewable, tariff. What is the right way of looking at power?
Yeah, see, I think again, I am betting it through power finance, because then it's more, more diversified. Because whether it's renewable, whether it's nuclear, whether it's thermal, any kind of power infrastructure which is built, it can fund the distribution network, it can fund the power generators across the board. You will benefit. Whether if you just bet on a specific play, like whether it's a wind or solar, it completely depends on the regulations. So regulations are unpredictable. And if there are tariffs applied in the US and your export market takes a hit, the company can come crashing down. Whereas this is much more safer play, where the gross NPAs and the net NPAs will almost be zero. They are writing back a lot of provisions they had taken in the past. They're delivering 20% kind of a return on equity, as well as 20% kind of a growth overall, and you're getting these companies at 1.2, 1.3 times kind of a multiple, whereas at the peak in 2012 they were trading at 3.5 times. So reasonably valued. They may have corrected, but these are the opportunities. One has to differentiate between which are the long-term sustainable stories, because India cannot grow without power. So if you are betting on India, you need to find risk sort of risk reward plays within power, which will deliver you over the next 3 to 4 years.